Welcome to Silver and Gold, your source for insight into the forces shaping the precious metals market. In today's video, we're diving into the powerful influence of central banks on the price of gold, how their policies, reserves, and monetary strategies quietly move the market. When we think of gold prices, we often imagine investors, jewelers, or even geopolitical tensions driving the market. But behind the scenes, some of the most powerful players influencing gold are actually central banks and governments. Central banks like the Federal Reserve in the US or the European Central Bank hold large reserves of gold. This gold acts as a financial anchor, helping to instill confidence in a country's monetary system. And while we're no longer on the gold standard, gold still plays a quiet but critical role in shaping economic policy. So, how exactly do central banks impact the gold market? First, there's supply and demand. When central banks buy gold, often as a hedge against inflation or currency risk, it drives demand, and therefore prices, higher. Conversely, when they sell gold reserves, this can increase supply in the market and push prices downward. But it's not just about buying and selling. Monetary policy decisions also influence gold prices. When central banks raise interest rates, gold becomes less attractive because gold doesn't earn interest. In high-interest environments, investors often shift to yield-bearing assets. But when interest rates are low or even negative, gold tends to shine as a safe haven. Another factor is currency strength. Central bank policies that weaken a national currency, like quantitative easing, can lead investors to seek protection in gold. Since gold is priced in US dollars globally, a weaker dollar often translates into higher gold prices. And let's not forget confidence and uncertainty. In times of political instability or financial crisis, central banks tend to hold, or even increase, their gold reserves. This signals caution, which can ripple through markets and prompt private investors to follow suit, driving prices up further. In recent years, central banks in emerging markets like China, Russia, and India have been major gold buyers, aiming to reduce their reliance on the US dollar. These large-scale purchases can create long-term upward pressure on gold prices, even if they're not grabbing headlines. So while gold might seem like a free-moving market, it's actually closely tied to the strategies and decisions of central banks worldwide. Their policies, their reserves, and even their silence all shape the landscape of the gold market in powerful ways. Thanks for watching Silver and Gold. If you enjoyed this video, be sure to like, subscribe, and hit the bell so you never miss a look into the world of precious metals. Until next time, stay curious, stay informed, and stay golden.